Okay, so this is a journal entry for a company that is raising capital. So if you've ever watched the show Shark Tank, what happens is people come on, they pitch their business, and then equity is sold in exchange for cash. And this is a common process for young businesses to raise capital. Even mature businesses sometimes go to the market and raise capital through selling equity or selling percentage of ownership of the company in stocks. And so how this shows up in the journal entry is a little bit unique. When a company sells part of their equity, they get cash. So that's the easy thing. So we always start with the things we can touch. So in this case, the company sold an additional 40,000 shares to investors at a market price of $3 a share, and the par value of the common stock is a penny a share. Well, at a market price of $3 a share, if they sold 40,000 shares, that is $120,000. So the cash, the actual cash raised here, is going to be, it's going to be a debit right here. It's going to be a debit cash of $120,000. All right. So we put a little debit here, cash, and this is something that's going to increase our assets. A debit of cash is going to increase our assets. Remember, this is the balance sheet where, I basically mapped this out so that we can see what is increasing and decreasing in our balance sheet related to these journal entries. So we have our debit of cash here, all right? And that is for the 40,000 times the $3 per share, all right? Then after that, we have actually two credits. We have a credit here and we have a credit here. And the credits are associated with two accounts, all right? One is called, and we'll move it over just a little bit, common stock. And that will be for $400. And the reason why it's $400 is the common stock value is 0.01 per share. So a penny per share. So a penny times 40,000 equals $400. So that's what we're going to write as the entry for our common stock. And the reason for this is a legal reason. There's how securities are structured essentially is that the common stock is sold for a fixed price, and then there's something called an additional paid-in capital, which is the net difference of that common stock value and the $3 per share. The easy way to calculate it is to say, okay, well, we know debits have to equal credits. Well, our debit is $120,000. This is $400, and so the net difference here is going to be $119,600. All right, so, and that's going to be in an account called additional paid-in capital. Of 119,600. All right. And so that's our debit and that's our credit. All right. And where these accounts go might not be super intuitive. Where they go is common stock is going to go here, and it's going to be increasing in your owner's equity. And then additional paid-in capital, we'll do additional paid-in capital, is also going to be increasing in owner's equity. You see, because credits in owner's equity increase it and debits decrease it. Assets is the opposite. Credits decrease assets and debits increase it. So that's why we define debits as left and credits as right. So our assets are increasing in cash, and our owner's equity is increasing in common stock and additional paid-in capital. And they're both increasing in the total amount, because there's two credits here and one debit, of $120,000. So that's the nature of doing a journal entry for raising equity.